J-Blog, August 9th, 2009. I'd like to continue with the S&P 500 PE ratio that I was talking about last time because some new information has surfaced since my last blog last week. And first of all, I'd like to say that I'm using the straight S&P 500 number straight off the website. No funny mixing numbers in the background or anything like that. There's a lot of conspiracy out there about how S&P is trying to cheat, blah blah blah. I don't really care about that. I'm just looking at the official numbers as they come off the website. So I'm looking at these numbers, and the first thing that I notice is how here, this is probably a bit small, but I'll read it for you. The S&P 500 P ratio topped out in the last recession in December of 2001 and March of 2002 at 46, which was this spike here. But if we're looking at the market itself, then we actually see here that it took until April of 2003 for the market to actually improve, even though the S&P PE ratio had started improving long before that, and was basically dropping down and then increasing again as of late. So the S&P 500 PE ratio is very much in this particular case a leading indicator, and the stock market, as it turns out, is a following indicator. So from that point of view, the green shoot crowd, for all I'm concerned, is out in space. I don't see any green shoots. I continue being bearish. I'm happy being bearish. Having said that, I still do have longs. I hold longs as well as shorts. I like to hedge between the two. And the market has definitely continued going up significantly. Longer, way longer than I thought it would. Here we're looking at the NYSE having gone up even after this decline, which I thought or hoped would be a bit more decline, but it never reached the second shoulder, that the right shoulder that I expected from this head and shoulders location, and just charged back up. Now from my point of view, it's good for my longs, and on my short side I just continue taking very small short positions to counter my long positions, and the longer the rally goes on, realistically, the more overbought the longs become, the cheaper the shorts become, and I can continue picking up more. Sooner or later, the market will run out of steam because from a fundamental point of view, there really isn't a recovery quite yet. As you can see, recoveries happen not on the spike of the S&P 500 PE ratio. They happen in the downturn of the PE ratio. And the PE ratio has not turned down. Actually, the new piece of information that I've just come across, last week the PE ratio on a monthly basis was 134, which is amazingly high. It's never been there before, at least in the data that I have access to. Now, as of the earnings back for July, it has actually risen to 144, which is even higher. This is, if you're looking at this is parabolic, and sooner or later this thing must come down, and when it actually does come down and it comes down to a reasonable point, then the market can start talking about a recovery. At this point, perhaps we're slowing the descent. That doesn't necessarily mean we won't hit the ground, and slowing the descent is not the same as going back up again. From my point of view, I don't see anything I want to own out there unless I've got it nicely hedged against something short on the other side. And that's just me. If you feel differently about it, then go out there and put your money on the line. I put my money on the line, and I'm always glad when other people put their money on the line, and if you make money with it, that's great. Sure, go ahead. I'm not buying anything at this point. US dollar saw a big jump on Friday, which could potentially once again be the start of something. This was a big jump. Last time a jump of this magnitude happened, it started a multi-day ascent of the US dollar, and generally the rule is that if the US dollar goes up, then liquidity will pour into the US dollar and therefore will pour out of commodities and out of the stock market again. The two are kind of go against each other. So this could potentially once again be the start of something new. Everybody is incredibly bearish on the US dollar, as if the US dollar would end. The question I have to ask is, where else is the liquidity going to go? Is it going to go into the euro? I don't think so. Europe at this point is even more unstable than the United States. Is it going to go into the yen? No. That's not going to happen either. And there is simply no other currency that can absorb that much liquidity. So I do not really see. The gold bugs, of course, would love for it to go into gold. If it actually went into gold, I think we'd be looking at a $6,000 to $10,000 gold price. I'm just guessing here, but gold would appreciate hugely, which I would like because I hold gold, but I do not see that happening. I do not see that the plan is going to go back into a gold standard anytime soon. So for the time being, I think the US dollar is going to be it. And once this US dollar starts climbing, then the stock market should once again fall. But for the time being, of course, it is increasing, and there's nothing I can do to argue with that. So my trading strategy has been, as I said, continuing to hold my longs, which are mainly steel and agricultural oriented, which have been doing quite well. And I've been shorting Apple. I actually shorted a tiny amount down here. I will be shorting maybe a little more here. It seems to be plateauing. It seems to be overbought. Could get more overbought, but if the market goes down, this puppy will go down along with the market. This is Agrium. This is one I hold, but I do sell options on it, so it would be in my benefit if it went down a little bit. Hopefully not too much. The financial bear 3 times, interesting one. Massively oversold on this one, and this is an index that actually at one point was worth 1,200. I hate to have been the person who bought right here. It is now trading at 25. The slightest hiccup in the financial markets will send this thing right over 100. I got some of that. Again, tiny positions. I leave myself lots of room to space things out. Goldman Sachs I have shorted. Again, tiny position. Let's see if there is finally a weakness in the armor of Goldman Sachs, which seems to have been invincible until this point, but there are many parties looking at it. They would like to know how it had spent all the money that the US government gave it. Here we see a bit of a drop in the stochastics. REM I don't have right now. I'm just looking at SKF. Is another one like FAZ. SKF I have. It's a double inverse. And I continue buying more, again very small pieces. And SRS, which is the ultra short real estate. Real estate is not yet coming back. People who think that the builders are going to build the same subdivisions as they've been building back until 2005, 2006 are out of their minds. There is lots of surplus property out there for sale. I do not see builders coming back anytime soon until that excess inventory has been sold, but for the time being SRS is dirt cheap. I don't mind picking some of it up because again, if there is a hiccup, it can go back double, triple, quadruple in price. Sounds good to me. I'll take some of that. And that's, as I said, that's been my strategy. As STL very strong, but my 10 minutes are almost up, so I gotta go. Good luck and happy trading. Talk to you next week. Bye.